Welcome back, everyone. This week, we're going to be talking about how money is made on the delta between price and value. Because, after all, price is what you pay and value is what you get. The focus of today's article is a phrase that I'm sure many of you have heard. Money is made on the delta between price and value. Let me give you an example of what that looks like. Let's say that someone is trying to sell you $100 for $50. The price would be $50, the value is $100, and the delta is $50. Money that is made is $50 or 100%. Now let's put all that together. Someone is trying to sell you a $100 bill, that's the value, for $50, that's the price. The difference between those two prices and points is $50. That's the delta. Since money is made on the delta between price and value, put differently, money is made on the difference between price and value, you get to make $50 or 100% upside. Recognizing this can help add clarity to other similar phrases such as price is what you pay and value is what you get. Both of these expressions prompt the listener to consider such things as worth and intrinsic value. It isn't that people think that a company has no worth, but that they just never give it any thought. But they are seemingly fine with participating in the stock, which means that they're little concerned with the thing that determines the other thing. So, if they're not buying and selling based on the value, since they don't understand the value, then what are they buying and selling on? And the answer is their emotions predominantly. Benjamin Graham's famous allegory about Mr. Market being a manic depressant helps highlight this point. It goes something like this. Mr. Market is a person who offers to buy or sell stocks every day. However, Mr. Market's mood swings are extreme and unpredictable. Some days he's exuberant and offers high prices for stocks, while on other days he is depressed and offers low prices. Mr. Market recognizes price more so than value. Another well-recognized piece of wisdom from Benjamin Graham is the following quote. In the short term, the market is a voting machine, but in the long term, it's a weighing machine. This quote recognizes that short-term price actions, price, is driven mostly by sentiment, headline news, and emotions, while in the longer term, it is driven by the underlying fundamentals and aligns more closely with the so-called intrinsic value of the company. Having a comprehensive character, being disciplined, having an understanding of value that's encapsulated within a longer-term time frame is antithetical to how most people act, though. They're sentiment-focused and not value-focused. In all fairness, how can you be value-focused if you're ignorant of the value? Doesn't that just leave sentiment? Most people can barely rotely regurgitate such phrases as money is made on the juxtaposition between price and value, let alone act in accordance with it. You come to find out that most people's adherence is in abstraction only. This concern with price with minimal regard towards valuation leads to interesting situations. It's what allows Apple to trade from a 20 times PE multiple to a 30 times PE multiple in 2023. Although its shares outstanding shrunk by only 0.5% and the earnings stayed practically flat, the PE multiple managed to still expand by 50% from 20 times to 30 times. Its price changed, but its value hadn't. Normally, today's quoted phrase is spoken in the context of badly beaten down sectors trading at a discount, a tangible book, net current asset value, or something of that kind. But it holds just as true for stocks that are high flying, that are going up. This is really worth knowing, because you could just as well say money is lost on the delta between price and value. Just because you pay a certain amount for something doesn't mean it's worth that, and that holds true both to the upside and the downside. People will overpay just as much as they'll refuse to underpay. Dollar bills, y'all. To keep the metaphor going, in all fairness, you don't know why that $100 bill is selling for $50. There must be something wrong with it for it to be so heavily discounted, right? You don't know that $100 bill. What's the history of that $100 bill? Is it just that $100 bill or all $100 bills that are selling at a 50% discount? These are reasonable questions to ask and be concerned with, but the whole point of asking a question isn't to rhetorically imply your disdain for something, but to genuinely get answers. They might say, it doesn't make any sense as to why someone would sell a $100 bill for $50. But remember this, things don't make sense until you look at it from a point of view in which it does make sense. In order for you to make sense of matters, you'd have to actually understand what has caused the downtrodden price. Most people are instinctually apprehensive towards stocks that are down a lot. The reason is they're value agnostic and price focused. A funny thing happens here too, but to the upside. When someone comes along and is bullish on a company, they'll compare it to its all-time high and then say it has that much farther on the upside. I'm not making this up. These aren't theoreticals. Here's a real tweet from a real person. This is a chart of Transocean, and the individual said, what you want to be doing, heavily manipulated by the hedge funds trying to manipulate their shorts. The breakout will be epic, going back to and beyond all-time highs. This above stock can be a 30-bagger, people will exclaim. The reason they'll say this is because they think that the company will start earning a lot more. But they're decontextualizing matters. They forget that shares outstanding relative to earnings is what determines a stock price. For example, all else being equal, if Transocean has diluted shareholders fourfold since 2008, when I believe the all-time high happened, then that would imply that the stock would only go back to the high 30s per share, not the 120 to 150 range. That's a 7x, not a 30x. Now you might say that's not bad, but what is bad is how they hold the stock even after the cycle turns, because they're anchored to a price absent of value. After all, why would they sell in the 30s when they think it has room to run to $150? And it's in them holding the delusional belief that they'll inevitably also be holding the bag. And just as most people act unreasonably paranoid to stocks with low prices, these individuals act unreasonably paranoid to anyone who tells them what I just mentioned to you. They create smaller stories to justify bigger stories, the stock going to $150. The smaller story is a trait of paranoia called persecutory delusion, in which they think they're being conspired against by haters or short sellers. A common theme that you might notice being developed is one of paranoid, unreasonable beliefs. The reason is simple. Their beliefs aren't based on reality. Price is treated as a floating abstraction void of reality, value, fundamentals. As such, they'll be hard-pressed to justify their actions with reality. So they just make up their own quote-unquote reality. If money is made on the juxtaposition between price and value, and you don't know what the value is, then that leaves just the price. This means that a smaller price is scarier than a bigger price, especially once they pull up a chart and see that it was once a bigger price. The entire world of investing is reduced to big prices and small prices. Most people are price theistic and value agnostic. It's not without its costs, at least opportunity cost. We all know the story of the parable of the economist and the $20 bill. If not, here it is. The story goes as follows. An economist is walking down the street and spots a $20 bill lying on the ground. Instead of picking it up, the economist continues walking, prompting a passerby to ask why they didn't pick it up. The economist replies that if the bill were genuine, someone would have already picked it up. The implication is that the economist believes that the rationale that the rational and self-interested individuals would have already taken advantage of the opportunity if it were truly valuable. This story is often used to illustrate the concept of efficient markets, rational behavior, and the idea that valuable opportunities are quickly taken advantage of in competitive and efficient environments. It suggests that in a well-functioning market, any mispricing or arbitrage opportunities would be exploited by individuals seeking to maximize their own self-interest and profit. Do you see how the economist's beliefs caused him to miss an opportunity? This is a more obvious example. A $20 bill is worth a $20 bill, obviously. When it comes to companies, you see it trading at $20 stock, but that doesn't mean that that's what it's worth. This $20 bill economist example might be considered silly, but the lessons to be derived from it are anything but silly. But isn't that ironic? People analyzing a parable without looking any deeper into the value it contains is similar to how they view a ticker symbol price without digging any deeper into the company's fundamentals and the value contained within it. Most people are superficial in their thinking, and it's in that fact that you realize that they're complicit in their own demise oftentimes. The consequence of underemphasizing value is that it leads to being fixed on price. But this creates the price to become a floating abstraction without any ties to reality. And trust me, reality almost always sets in. It takes the truest of believers to not get shaken by its effects on the price. Over a meaningful period of time, price is a derivative of value. You'd think that people would care more about the thing which drives the other thing. But it isn't uncommon for people to put the cart ahead of the horse. I covered this idea when it came to prioritizing decisions over outcomes and decision-making in general in this article and this article. Most people are price bigots. Here's an example of it in regard to my current largest holding. Comment says, "No thanks. If I have learnt any lesson in this space, don't buy the small fish. Sure, you could have outsized returns, but they could also just as easily go under." That's an interesting phrase. Let me make a side note here. Just as easily go under. So they could just as easily go under as just as easily have outsized gains? So was that like a 50-50 probability? So does that mean that you can either be a 10x or what, a 100% loss? You have 50-50 odds? How many times should you take that bet? Or 100x? Like, what does it mean just as easily? For those interested in how I feel about the word just, you should just go read my article on the word just. But I digress. This is a small fish bigotry. Bigot, someone who discriminates against something on the basis of their membership of a particular group. In this case, that group is small fish. For instance, a lot of money can be made and has been made when it comes to the resource sector, but I know that it's full of grifters and I can't differentiate between the sincere ones and not. Nor do I feel like I have any edge in geology. Therefore, for all intents and purposes, I discriminate against the sector as a whole. Let me ask you this. What percentage of people who own a mining stock have ever looked at a NI 43101 report? How many people even know what one is? All they care about is some discovery and how the price is going to respond to that discovery. Hell, even the word discovery is a placeholder word for the phrase exciting news. Being skeptical about buying a $100 bill for $50 is to adopt the phrase, if it's too good to be true, it probably is. Taken too far. Instead of being an absolutist and literalist, you have to be more flexible in your modeling of the world. Such questions should occur in this situation. Might the $100 bill be counterfeit? It must be a debunked currency that's no longer exchangeable for goods, right? People must know something I don't know. Who am I to know anything? All of these are reasonable questions to ask, but let me remind you again, the point of asking a question is to get an answer. In the realm of stocks, you might find that a large shareholder or fund is getting unwound and are forced sellers. Remember earlier how I said to you that things don't make sense until you look at it from a point of view in which it does make sense? That's a situation. Here's another situation. Perhaps the company cut their dividend and is getting kicked out of a dividend ETF, creating forced selling. Perhaps a company got formed into a spin-off and the market cap of that new company is below the criteria of the funds holding the parent company, so they become forced sellers. You won't know any of this if you don't look. One reason the house prices are so expensive in certain gateway cities is because people are trying to get their money out of their domiciled countries. They rather overpay for an asset if it means that they can free their money from their country's capital controls. In this instance, people might pay $200 for $100. This means that so-called irrationality might make good sense in the right context, but how will you know that if you don't evaluate it? Think about how IPOs are often issued, and then you can see why they often moon before collapsing. The IPO a stock with a fraction of the total shares outstanding, with a tight float, so that way it has a tight float. This lack of free float allows the shares to be more easily worked higher, and then when the IPO unlock occurs, the insiders can dump their shares at an artificially inflated price, while simultaneously a deluge of locked up shares hits the markets and overwhelms the buyers. And the buyers soon stop buying because who wants to buy something when it keeps going down every day? The parallel with today's example is that people get a false impression that something is a good buy because it keeps going up in price, when unbeknownst to them, it's not because of the underlying value of the company improving, but because of some structural market reason. But people's paranoia is seemingly only triggered when price goes down and not up. People rarely ask why a stock is going up, but have infinite questions and concerns when a stock starts going down. And it's that fact that makes this tight float IPO maneuver a timeless classic. The price of an IPO stock went up, but its value didn't change. This invokes the opposite, but just as important version of today's quote at play. Money is lost on the delta between price and value. Another natural state of people is that they live by the motto, price confirms narrative. Instead of doing research of a company and getting a feel for its value and thus their belief in why it would go up, people instead ignore all of that and just buy stocks that are already going up. But doing this means that you make less money due to the gap between price and value getting closed, which means that your speculation has less asymmetry than it otherwise could. Another problem arises too. If you plan on realizing any serious gains out of a stock to the tune of hundreds of percent, it most likely will be punctuated by a gut check moment. Call it a 50% drawdown or a 20 or 30% drawdown. And this is when the paper hands get shaken out, sometimes at a loss, sometimes not. It's because they have no real opinion around the value of the company, which means that they don't have the courage of their conviction to hold the stock during a prolonged or even sharp drawdown or an earnings dip. This means that people aren't able to do what it is they say they want, which is to buy companies with a 5 or 10 bagger potential. Sure, they buy companies with a 5 bagger potential, but never actually realize anything near those returns. They're too busy trading price instead of buying right and sitting tight around value. And this is why most investors in the Magellan Fund lost money despite it having double-digit returns for a, decade or two. This is what also causes so many funds to underperform. It's easiest to raise money for a fund after a few good years of price appreciation within a sector, but when valuations are lofty is when it's the worst time to buy in size. Yet that's when the fund manager gets the bulk of their money from investors. So they end up buying high, underperforming subsequently, and then becoming forced sellers as their newly invested partners redeem them. All of this combined means that most people will wait for the $100 bill to be priced at $100 before buying it. I kid you not. They might even wait for the $100 bill to be priced at $110 or $120. The reason they do this is because it's then considered a safe bet. But with that safe bet, practically all money to be made has vanished. If money is made on the difference between price and value, then how much money is there to be made buying $100 at $100? There isn't, but that's what people do. People want comfort found in the confirmation of others. They want their narrative that the $100 is actually worth $100 to be validated by others first. They want other people's approval. They've consigned their investment decision to others. Most people don't have a mental point of origin, outcome independence, and courage of their conviction. Most people seek comfort, validation, and consensus. The final problem I'll note is how people treat stock prices as a floating abstraction that's not reflective of underlying assets, cash generation, etc. Holding a stock long term is predicated on having the courage of your conviction around the value. Without having some sense of value, the price information is a floating abstraction. Money is made on a juxtaposition between price and value and increasing value when you've already paid the price. This is why most people are shorter term traders with paper hands. It is my belief that less and less people care less and less about value. And not just the retail crowd, but the prop desks, pod shops, algos, technical analysis traders, etc. Practically everyone is some derivative of value agnostic, short-term price chasers. This can increase the magnitude of moves to the upside and the downside, as well as the speed of those moves. This could lead to more volatility and more drastic moves, but all the while still hovering around the value of the stock. Quicker votes, but roughly the same weight to appropriate the earlier Graham quote. It appears that the length of a hold is proportional to a person's understanding of its value. People's lack of understanding about a company's value is a consequence of not wanting to put in the work due to a misguided belief that they don't need to, which leads to a higher turnover rate in people's portfolios. And it would seem that higher turnover rates negatively affect their ability to compound their capital. More decisions invite more unforced errors and allow them to get whipsawed around in their positions, triggering stop losses and shaking their conviction. Conviction in what? Exactly. They don't have conviction, which leads them to their emotions to determine their trades. And emotions like to buy tops and sell bottoms. This idea of validation seeking and waiting for the consensus to spend $100 for that $100 bill that I mentioned a moment ago and finding comfort among the crowd is interesting because a lot of people chronically complain about how stupid other people are. And what is the stock price but what other people think? Do you see the irony in that? Essentially, by them waiting for someone else to value the $100 bill at $100, is them saying, I'm going to wait for a bunch of stupid people to indicate to me what it is I should do. Now, let me ask you this. Doesn't that sound pretty contradictory and stupid itself? One way of framing matters is by saying that the endeavor of making money is intelligence arbitrage. This helps us better understand such proverbs as, a fool and his money are soon parted. Once we think about making money along the lines of the delta, the difference between your intelligence and others, then it goes to reason that you have to buy before the price dramatically inflects up. The reason that you're able to buy a stock before its value, the reason that you're able to buy a stock below its value is due to people selling it below its value. You need the so-called stupid people to create a scary low price, so you're able to buy something at a discount to maximize the money you make. But this is the opposite of what a lot of people do. My recommendation is don't be complicit in your own unraveling. There are enough people trying to separate you from your money as it is. You don't need to be one of them. Thank you for listening, and until next time.